Welcome to Phillip Mastermind. My name is Kim. Investors often look for seasonal patterns to guide their portfolio decisions. While the saying goes, sell in May and go away, our observations indicate that September has historically been a weaker month for global markets and local markets. Before I start, I'd like to make a disclaimer that past performance is not indicative of future results. That said, historical data suggests that certain seasonal patterns, such as September weakness, have shown some statistical significance. However, these trends may not persist in the future. Investments are subject to market risk and returns can fluctuate. Readers should carefully consider their investment objectives and risk tolerance before making any investment decisions. Let's start with our analysis. Over the past 10 years, the MSCI World Index posted an average return of negative 1.92%, with 5 out of those 10 years in negative territory. Similarly, the MSCI Asia Pacific Index averaged negative 1.96% in September, recording losses in 6 of the past 10 years. The largest constituent of the MSCI World Index, the US market, also reflected this trend, with the S&P 500 averaging negative 1.96% and the tech-heavy Nasdaq recording negative 2.48% in September. China's CSI 300 index bucked the trend with a modest positive 0.56% average return in September, though this was largely skewed by 2024's exceptional policy-driven rally. Excluding that, the month has generally been weak. The Hang Seng Index also underperformed, averaging negative 1.4% in September over the past decade. Locally, Malaysia mirrored the broader trend. The KLCI averaged negative 2.2% in September, while the FBM Emas Index, which represents the broad Malaysian equity market, covering the top 98% of Bursa Malaysia's companies by market cap, recorded an average return of negative 1.67% over the same period. When the market is weak, the right action depends on your investment goals, risk tolerance, and time horizon. We'd like to share 5 useful tips below. Number 1, stay calm and avoid emotional decisions. Weak markets can trigger fear-driven selling. Panic selling lock in losses. Remind yourself that market downturns are normal and often temporary. Number 2, review your portfolio. Check if your portfolio is still aligned with your long-term objectives and rebalance if necessary to maintain your intended asset allocation. Number 3, look for opportunities. Weak markets can create buying opportunities for fundamentally strong assets at lower prices. Consider dollar cost averaging, i.e., investing regularly to smooth out volatility. Number 4, protect your portfolio and ensure diversification across asset classes, sectors, and geographies. Consider hedging strategies if appropriate, i.e. investing into bonds, gold, or defensive stocks. And finally, number 5, keep a long-term perspective. As historically, markets tend to recover over time and avoid trying to time the market. It's almost impossible consistently. Where the opportunities lie for the rest of 2025? In our view, valuation remains one of the most reliable gauges to identify opportunities. Valuation measures potential risk and reward. When the market is trading at a reasonable or discounted valuation relative to historical averages or fundamentals, i.e. earnings, book value, and cash flow, the downside risks tend to be lower and the potential upside is higher. Overvalued assets, on the other hand, may struggle to deliver meaningful returns even if the market recovers. Based on our analysis, the MSCI World Index and MSCI Asia Pacific Index are currently trading above their historical 10-year average PE ratios. The MSCI World Index stands at 20 times, approximately 1.6 standard deviation above its 10-year mean PE, while the MSCI Asia Pacific Index is at 15.2 times, around 1 standard deviation above its 10-year mean PE. Unless earnings growth can catch up meaningfully, valuations appear stretched in our view. The bright spots remains Malaysia, with the KLCI Index and FBM Emas Index trading at 13.9 times and 14 times PE respectively, approximately 1 standard deviation below their historical mean. After months of underperformance, we believe Malaysia is poised for a rebound, underpinned by strong economic fundamentals and supportive government policies that provide a solid foundation for sustainable growth. Foreign ownership remains near historical low at 19% as of July, suggesting meaningful potential for incremental capital inflows. Against a backdrop of heightened global volatility, Malaysia presents an attractive opportunity for investors seeking resilient growth and value. Key initiatives such as New Industrial Master Plan 2030, the National Semiconductor Strategy, and the Johor-Singapore Special Economic Zone are expected to drive infrastructure development and energy demand, while the upcoming National Investment Incentives Framework and the next phase of reforms under the 13th Malaysia Plan should further reinforce investment flows. We expect multi-year tailwinds in thematic sectors such as construction, digitalization, and energy transition. While execution risks remain, particularly around fiscal reform and governance, 13 MP provides a credible framework for Malaysia's structural transformation. Near-term headwinds persist from rising cost pressures, including SST, electricity tariff, and EPF contribution for foreign workers. But we think that the strong domestic liquidity, attractive valuations, and proactive policy support could help mitigate downside risks and support selective buying opportunities in the near term. A noteworthy avenue for investors seeking diversification in their portfolio is through Phillip Capital Malaysia. Phillip Capital Malaysia offers multiple prime mandate services managed by professional fund managers. By leveraging Phillip Capital Malaysia's prime managed account services, investors can enhance their resiliency, optimize portfolio performance, and navigate the complexities of the market with confidence. Apart from our inaugural prime managed account services, we also offer unit trust funds, PGWA, that could cater to different investors' needs. That's all for today. Stay tuned for our next Phillip Mastermind. This update is brought to you by Phillip Capital, your partner in finance.